this video, let's explore the Wells-Wilder smoothing, or as it's known, the WWS. There are so many different moving average types indicators in the technical analysis world, but this one is different due to its recursive calculation, due to the, I would say, heavier weight it gives to the historical data, and due to the formula which calculates the current value, and each current value depends on the historical data, it gives a smoother version to ongoing trend. So where do we find this indicator? How do we put it on the chart, and how do we actually use that? Under the indicator section here, you go to the trend, and the last one on the list, the Wells-Wilder smoothing, comes by default at the periods of 14, applies to the closed data. Under the lines, you would be able to choose the type and the thickness of the line, as well as to define the visibility on the time frames and the type of the chart you want to see that. After it is on the chart, you can see it looks like any moving average. However, look how smooth it goes. The line is very, very, very clean without many fluctuations, which could cause much more false signals. This one, due to its recursive calculation, is again gives more more value or heavier value reliability on the historical data rather than the very current one. So it helps a lot with identifying cleaner trends. It helps a lot to identify ranges, because if the moving average is unable to create higher highs, higher lows, but it moves like look like in that case, high, low, no higher high, and no lower low. This helps identify clean ranges conditions. And therefore, when the real trend happens, you would see such cases when the breakout of the moving average type, and then the moving average goes smooth. It helps to find great entry points. This type of indicator is usually best to combine with the indicators like RSI, MACD, and other oscillators that will give more valuable signals. But another way the traders love to combine that is double the value. So you go and you put another Wells-Wilder smoothing with heavier data, let's say 50 periods. You give it a different color, just for the case of the example, say white. And the idea here is, as the market is above the white line, the bigger or the broader scale of the indicator, that every time this one drops below, the price drops below the smaller one, the shorter period, it gives you the signals for potential trend continuation. Of course, it also helps with situations like in the opposite directions. And when the let me show you here in this example, and if the bigger data here doesn't, let's say that the white line doesn't have a clean direction and it is pretty much flat, that's exactly the situation which you will want to avoid trading. And it gives a great visual help when the white line is flat and it is crossing too often. When the white line, which is the longer period scan, when it is crossed back and forth too often, that means that there is no clear control by the buyers and the sellers, and you would want to avoid this kind of trade.